Ever seen a stock rocket and cash fly like a punchline?
Haha.
We're diving deep into the world of fast stocks, fast money.
Yeah.
And let me tell you,
Mm-hmm.
it's wilder than a Wall Street roller coaster.
Oh,
I
yeah.
remember back when I was just starting out,
Oh, yeah.
I poured everything I had into this hot new tech IPO.
Okay.
Everyone and their mother said it was going to the moon.
The allure of those quick wins, man.
Oh, yeah. I was hooked.
Mm-hmm.
I thought I'd be sipping champagne on my yacht in no time.
Oh, the dream.
But then reality hit.
Oof.
The company missed its earnings, the stock tanked,
Oh, no.
and I was left holding the bag.
You learn the hard way
It
sometimes.
was a brutal lesson,
Yeah,
but it taught me the importance of looking beyond the hype
absolutely.
and really understanding what I was investing in.
A crucial point.
Yeah.
It perfectly sets the stage for our deep dive today
Okay.
into Robert Natale's book, Fast Stocks, Fast Money.
Okay.
He was an editor at S&P's Emerging and Special Situations newsletter for years, so
Oh, yeah.
he's seen it all.
Yeah.
He doesn't sugarcoat the risks,
Right.
but he gives us a framework to make smarter decisions,
Okay.
especially when it comes to small cap stocks and IPOs.
Okay, so let's unpack this. First up, why are small stocks so tempting?
Mm-hmm.
And what makes them so risky?
Well, think about the equity risk premium.
Okay.
That's the extra return investors expect
Right.
for taking on the risk of owning stocks instead of something safer like bonds.
Right.
With smaller companies,
Yeah.
the premium is even higher
Makes sense.
because they're often less diversified,
Mhm.
have weaker balance sheets,
Right.
and less predictable cash flow.
It's like those scrappy startups,
Exactly.
full of potential,
Yeah,
but also a lot more vulnerable.
for sure.
But here's what I found surprising. Natale says small stocks aren't as risky as you might think,
Interesting.
but only if you hold them for more than 5 years.
There's that long game again.
Right.
Time plays a huge role in managing risk.
Okay?
Ibbotson Associates,
Mm.
a well-known investment research firm,
Right?
found that the chance of losing money in small stocks drops dramatically the
Okay.
longer you hold them.
Interesting.
Over 1 year,
Yeah?
you have a 29% chance of losing money.
Wow.
But over 10 years,
Okay.
that plummets to just 3%.
3%. That's a game changer.
It is.
Yeah. It's like playing the long game instead of trying to time the market for a quick buck.
Exactly.
Right.
Patience becomes your most powerful asset.
Patience. I like that. Speaking of patience, let's talk about IPOs. That whole world feels like a jungle,
Mm-hmm.
full of hype and potential pitfalls.
Yeah, it can be.
Yeah.
And one trap that often catches inexperienced investors
Yeah.
is this concept of a blind pool.
A blind pool.
Yeah.
Sounds shady.
Essentially, it means you're investing in a company with no clear plan for how the money will be used.
Oh, wow.
Like giving someone a blank check and saying, "Surprise me!"
Yikes.
Avoid those at all costs.
Okay, good to know.
Another thing to watch out for is
Yeah.
the intense sales pressure surrounding IPOs.
Oh, yeah, you've got brokers pushing those IPOs hard,
Absolutely.
promising the moon.
And their incentives are often tied to how many shares they can move.
Ah, interesting.
Underwriting fees are typically higher for IPOs,
Gotcha.
so there's a strong motivation to create that buzz.
Okay.
This can create artificial demand,
Hmm.
especially from less knowledgeable investors who get caught up in the hype.
Natale uses the example of Genentech to illustrate this.
Okay.
It went public at $5.83.
Wow.
Closed the first day at almost $12,
Nice.
but 5 years later, it was trading lower than that first day's close.
Classic case of hype over substance.
Wow.
It's a reminder to look beyond the initial buzz and really evaluate the company's long-term prospects.
Yeah, and to do that, we need to learn how to decode the prospectus, right?
Right.
But let's be honest, those things can be sleep-inducing.
Oh, I know. I can be daunting.
Yeah.
But Natale reassures us that we don't need to become accounting wizards
Okay, good.
to extract valuable insights. He says to focus on the management discussion section.
The management discussion?
Yeah.
Why is that so important?
That's where you can start to project earnings.
Okay.
Natale advises us to look for changes in expenses as a percentage of revenue
Mhm.
combined with revenue growth trends.
Okay.
For example, he uses Consolidated Products,
Mhm.
the company behind Steak and Shake.
Okay.
Back in 1996,
Mhm.
earnings growth was projected at 22%, then 16%.
Wow.
But the stock was trading at under 10 times earnings
Okay.
because the whole restaurant industry was out of favor at the time.
So even with solid growth projections,
Yeah,
the market sentiment can drag a stock down.
absolutely.
Yeah.
It's essential to understand both the company's fundamentals
Right.
and the broader market context.
Okay.
This is where things get really interesting.
Okay, I like interesting.
This is where Natale introduces a powerful concept.
Okay.
Growth at a reasonable price, or GARP.
GARP.
Yeah.
Okay, I'm intrigued. Tell me more.
It's the S&P's secret weapon.
Ooh, secret weapon. Okay.
Finding undervalued stocks.
Sounds promising. So we're looking for those hidden gems,
Exactly.
the companies that are killing it,
Mm-hmm.
but haven't yet become Wall Street darlings.
Right.
But how does S&P actually find these GARP stocks?
They have two systems working in tandem.
Okay.
The first is called STARS,
Stars.
a qualitative, analyst-driven approach
Okay.
where experts dig deep into a company's story.
Gotcha.
The second is fair value,
Okay.
which is all about crunching the numbers
Mm-hmm.
and looking for quantitative signals.
So they've got human intuition and data-driven analysis working together.
The best of both worlds.
What kind of results have they seen with this approach?
Well, its Platinum portfolio,
Okay.
which combines both systems,
Mm-hmm.
has consistently outperformed the market.
Wow.
It's a testament to the power of blending those two perspectives.
I'm sold on GARP.
Good.
But how do we, as everyday investors, actually put this strategy into action?
It's about using those projected earnings estimates and long-term growth trends
Okay.
to figure out what a fair price-to-earnings ratio would be.
Mm-hmm.
Natale gives a great example.
Okay.
With Tractor Supply,
Tractors.
the retail chain for farmers, earnings were projected at $190 per share
Okay.
with a 20% growth rate.
Wow.
Long-term bond yields were at 6.3%
Uh-huh.
using the Graham and Dodd formula,
Okay.
a classic valuation method.
Right.
They calculated a fair price of $65.
Okay.
But here's the kicker.
Yeah.
The stock was trading at $26.
Less than half of what it was potentially worth.
Yeah,
Talk about a potential bargain.
exactly. That's the power of GARP.
Yeah.
It helps us spot those opportunities the market might be
This is all starting to make sense.
Good.
But before I get too excited and start throwing money at every undervalued stock I can find,
Yeah, be careful.
right?
Let's talk about the potential pitfalls.
Okay, yeah.
What red flags should we be watching out for?
What should we avoid?
One of the biggest is debt.
Debt, okay,
Companies that rely heavily on borrowing can be vulnerable,
right.
especially if interest rates rise or the economy takes a hit.
It's like building a house of cards on a shaky foundation.
Oh, very good analogy.
Right.
Another thing to watch out for is insider selling.
Insider.
If company executives are dumping their shares,
Okay.
it could signal they lack confidence in the future.
Actions speak louder than words, right?
Absolutely.
Yeah.
And speaking of red flags,
Mm-hmm.
be wary of companies with a history of legal or regulatory issues.
Legal issues, okay.
Lawsuits and investigations can drain resources
Right.
and create uncertainty.
Definitely something you want to avoid.
Yes.
What about the management team?
Yeah, that's a good point.
What should we be looking for there?
Experience and a solid track record are crucial.
Okay.
Look for leaders who have navigated companies through tough times
Mm-hmm.
and have a history of making smart decisions.
Like a captain who can steer the ship through stormy seas.
Exactly.
Yeah.
And just as important
Okay.
is alignment with shareholder interests.
What does that mean?
You want a management team that's focused on creating long-term value for investors,
Right.
not just enriching themselves.
Gotcha. So we're looking for a solid management team
Yeah.
with a track record of success
Mm-hmm.
and a focus on shareholder value.
Exactly.
Okay, but what about the company's actual products or services?
Right.
How do we assess those?
Look for a competitive advantage.
Competitive advance?
Something that sets the company apart from the crowd.
Okay.
It could be a unique product,
Mm-hmm.
a loyal customer base, a proprietary technology,
Mm-hmm.
or a strong brand.
So basically they need a secret weapon,
Pretty much.
something that gives them an edge in the market.
Exactly.
And consider the size of the market they're targeting.
Okay.
Is it growing or shrinking?
Yeah,
Even with a great product,
right.
a company's growth potential is limited if the market itself is stagnant.
It's like trying to sell ice to Eskimos, right?
Exactly.
No matter how good your ice is,
Right.
you're not going to have much success.
That's a good one.
Yeah.
Natal also provides some insights on specific industries.
Mhm.
For example,
Yeah.
he's bullish on wireless telecommunications.
Wireless.
It
Okay.
has exploded in recent years
Right.
and still has plenty of growth potential.
Makes sense.
Yeah.
It's an industry that's constantly evolving and innovating.
Exactly.
Neat.
He highlights Qualcomm,
Qualcomm.
which went public in 1991 at $8
Wow.
and soared to over $300 by 1999.
Wow, that's the kind of growth story that gets investors drooling.
It is.
Right.
But it's important to remember that not all wireless companies will be winners.
Right.
You need to be selective
Mhm.
and do your due diligence. No jumping on bandwagons just because something is trendy.
Right.
What are some examples of companies that got caught up in the hype but didn't deliver?
Natale uses the example of Home Shopping Network back in the 1980s.
Home Shopping Network.
It was a huge fad,
Yeah.
and the stock went on a wild ride,
Oh, no.
going public at $18, surging to $46,
Wow.
then crashing back down to $8 within a year.
Ouch.
Yeah.
Another reminder that fast gains can disappear just as quickly.
Exactly. It all boils down to this.
Okay.
Don't get blinded by hype.
Don't get blinded by hype.
Look beyond the flashy headlines and dig into the marketing's fundamentals.
Okay.
That's how you separate the real opportunities from the fleeting fads.
Okay, I'm feeling like a stock detective now,
Uh-huh.
Armed with all this knowledge about GARP,
Mm-hmm.
red flags,
Yep.
and the dangers of hype.
Yeah, absolutely.
But how do we actually put it all together
Yeah.
and build a winning investment strategy?
That's where Natale's insights on portfolio construction come in.
Okay.
He's a big advocate for diversification.
Diversification. Don't put all your eggs in one basket, right?
Exactly. Spread your investments across different sectors, industries, and even company sizes.
Right.
That way you can help mitigate risk.
Mm-hmm.
If one stock takes a hit, others can hopefully cushion the blow.
It's like having a safety net for your portfolio.
Yeah, I like that.
Makes sense. But how much should we allocate to these fast-growing small-cap stocks?
Natale suggests limiting your exposure to around 10–20% of your overall portfolio.
Okay.
That way you're participating in the potential upside,
Right.
but not overexposing yourself to the risks.
So it's about finding that sweet spot between risk and reward.
Exactly.
Now let's talk about selling. Knowing when to hold them and when to fold them can be tough.
It definitely can be.
Yeah.
And Natale acknowledges that there's no one-size-fits-all answer.
Right.
But he does offer some valuable guidance.
Okay.
He emphasizes the importance of having a clear exit strategy
Okay.
before you even buy a stock.
So set a target price or a certain percentage gain and stick to it?
That's one approach.
Okay.
And be prepared to reevaluate your investment thesis regularly.
Regularly. Okay.
If the company's fundamentals change or the market conditions shift,
Right.
you might need to reassess your position.
It's like checking in with yourself and asking, do I still believe in this company and its potential?
Exactly. And don't be afraid to take profits.
Yeah.
It's easy to get greedy, especially when a stock is running hot.
Oh, yeah.
But remember, what goes up can come down.
Yeah. I've learned that lesson the hard way. It's better to walk away with some gains than watch them evaporate because you held on too long. You got it.
Natale emphasizes that investing is a marathon, not a sprint.
Right.
It's about building wealth gradually, not trying to get rich quick.
It's like my dad always told me, slow and steady wins the race. But in this fast-paced world, it's easy to get caught up in the frenzy of fast money.
It is. That's why it's crucial to stay focused on your long-term goals and not get swayed by the hype.
Mm-hmm.
Remember, the market is constantly evolving.
Yeah.
And so should our knowledge and strategies.
So keep reading, keep learning, and keep those prospectuses handy.
You got it. And stop questioning, exploring, and seeking those opportunities for growth at a reasonable price.
Well, there you have it, folks, our deep dive into fast stocks, fast money.
It's been a wild ride.
We've unpacked a lot of information.
We have.
From the psychology of those quick wins to the strategies for navigating the sometimes treacherous world of IPOs and the power of GARP investing.
Don't forget the red flags.
Right. We've learned from Robert Natale's decades of experience.
Years of wisdom.
And gained insights into those crucial red flags and the principles of building a balanced portfolio. Now knowing what you know about the potential pitfalls of hype, the importance of due diligence, and the power of patience, what one stock are you going to reevaluate through this lens?
That's a great question for our listeners. Take a look at your portfolio. Don't let the allure of fast money blind you to long-term value.
And hey, share your reevaluated stock picks with us on social media using the show's hashtag. Hey, let's keep this conversation going.
Until next time, happy investing.